All right, today we are jumping right into a fascinating puzzle at the very heart of the U.S. economy. It's a story of conflicting signals, hidden dangers, and a massive $22 trillion question that affects all of us. Let's get into it.
So here's the deal. On one side, you've got all these reports saying the internal plumbing of our financial system is getting dangerously tight. You know, the cash that banks need to operate smoothly every single day is starting to run low, and that risks major instability. But then, on the other side, the broader economy, that giant reservoir of money held by you, me, and businesses, seems to be completely full, maybe even overflowing.
So how is that even possible? How can the system be starving for cash while the economy is still swimming in it? It sounds like a total paradox, right? Well, that's the financial mystery we are going to solve together today. It's time to follow the clues.
Okay, clue number one. It all starts with this critical safety feature of the financial system. Think of it like a giant shock absorber that, until pretty recently, soaked up any big jolts. The problem? It has basically vanished. This shock absorber is called the Overnight Reverse Repo Facility, or the ONRP for short. The easiest way to think about it is like a giant piggy bank offered up by the Federal Reserve. When big financial firms have way too much spare cash just sloshing around, they can park it here overnight, nice and safe. Its whole job was to soak up all that excess money and keep the system stable.
And the scale of what's happened here is just staggering. At its peak back in late 2022, this facility held over $2 trillion of spare cash. That's trillion with a T. But today, that balance has collapsed to virtually zero. An entire $2 trillion buffer has been completely drained from the system.
So what happens when a $2 trillion shock absorber just disappears? Well, the system loses its safety margin big time. All those little daily financial jolts that used to get smoothed out without anyone noticing, now they're hitting the system directly, and that dramatically increases the risk of a sudden cash crunch. This is the first big piece of our puzzle. So let's see what this missing safety net really means. With that giant buffer gone, another powerful and highly volatile force is now shaking the system directly. And this brings us right to clue number two, the U.S. government's own checking account.
This is the Treasury General Account, or TGA. You can just think of it as the government's wallet, held at the Fed. And this wallet is incredibly volatile. I mean, on any given day, as taxes flow in and government payments flow out, its balance can swing by a mind-boggling $100 billion.
And this is where the new danger really comes into focus. Before, when the TGA balance shot up, say on tax day, the money was just pulled from that massive RRP buffer we talked about. No problem at all. But now, with the RRP totally empty, that same withdrawal hits the very core of the banking system, bank reserves. It's like yanking a support beam right out of a building.
And you know what? This isn't just a theory. We have a smoking gun. A major tax and bond settlement day back on September 15th gave us crystal clear proof of just how fragile the system has become. The numbers really tell the story. On that day, the overnight market rate, it's called SOFR, and it's basically the cost for banks to borrow cash, it spiked to 451 basis points. Now that was a full 18 points above the Fed's own target rate. This was a flashing red light on the dashboard, a clear signal of a cash shortage in the system, all triggered by the TGA's volatility. This brings us to our final clue, and really the heart of the matter. We've seen the shock absorber vanish and the government's wallet become a source of instability. So who's the ultimate victim of all this pressure? Well, it's the very foundation of the banking system's liquidity.
We're talking about bank reserves. This is the actual cash that banks keep at the Fed. It is the final backstop, the bedrock of liquidity for the entire system. It's also been the primary target of the Fed's policy of quantitative tightening, or QT, which has been systematically draining these reserves to fight inflation.
And here's where we are right now. Those reserves are sitting at about $2.9 trillion. And this number is getting dangerously close to what the Fed itself considers the minimum level needed to keep the system stable. The red line is approaching fast.
So why is this a danger zone? Well, the Fed does not want reserves to become scarce. They have some very bad memories of the market panic back in 2019 when that happened. On top of that, new regulations actually require banks to hold more reserves now than they did in the past. It's exactly why you're hearing Fed Chair Powell signaling that QT might end soon. They know they are flying very close to the ground.
Okay, so we have all our clues. The vanished shock absorber, the volatile government wallet, and the core reserves getting squeezed under pressure. I think it's time we put it all together and finally solve the paradox we started with. And here's how it all fits.
The paradox is explained by the crucial difference between the financial system's internal plumbing and the economy's overall reservoir. The plumbing, that's made up of things like the RRP and bank reserves. That is where the Fed's tightening has created all this stress. But the reservoir, the total money supply in the economy, known as M2, well, that's a completely different story.
And this is the key. Just look at the difference in scale. It is immense. The bank reserves keeping the plumbing running are down to about $2.9 trillion. But the total M2 money supply in the broader economy is a colossal $22.2 trillion. The plumbing can absolutely be under pressure while the reservoir is still overflowing.
So, the mystery is solved. The Fed's policy, QT, has been very effective at draining the micro-level plumbing where banks transact, making it tight and fragile. But it has barely made a dent in the macro-level reservoir of cash that flooded the economy during the pandemic. And that is how both of these things can be true at the same time.
But solving one mystery immediately presents another one, a huge dilemma for the Federal Reserve and for the future of the economy. What do they do now? Here is the incredibly difficult trade-off they're now facing. They can stop their tightening policy to fix the fragile plumbing and prevent a short-term market crisis. But if they do that, it leaves that $22 trillion reservoir of cash sitting in the system, which risks higher inflation and asset bubbles for years to come. They are caught between ensuring short-term financial stability and fighting for long-term price stability.
Which leaves all of us with this final, critical question. The Fed knows how to fix the plumbing. They can stop tightening or even add liquidity if they have to. But can they ever truly drain that massive reservoir without breaking the plumbing in the process? That is the multi-trillion-dollar question they now have to answer.